Hey everyone, Aaron here, and welcome to my channel, Millenica, where we cover investment strategies in an easy to understand way that allows anyone to be able to put them into practice. So today I wanted to kick it off by talking about the price earnings ratio. Now, when people are first looking to invest in specific stocks, they tend to get bombarded by all the different metrics available to them, and it's often pretty tough to tell if you're buying the stock at a fair price. So I wanted to give you an intro here into the price earnings ratio, often called the PE ratio for short. Now, the PE ratio is an essential tool that most skilled investors use when evaluating a stock. But at the same time, it's often misunderstood and has some shortcomings. So if you don't fully understand it, you might not be using it correctly to maximize your investment strategy. So today we're going to cover the PE ratio at a high level, and then in subsequent videos, we'll cover more ways that you can actually leverage this deeper to improve your investment strategies. So let's get started. All right, so the price earnings ratio, or PE ratio for short, it's simply calculated as it says in the name. You take a company's stock price and you divide it by the company's earnings per share. So, as an example, let's say we have ABC Company and their stock right now is priced at $20. The company is posting an earning per share of $2. So to get their PE ratio, you would take the price, $20, divided by the earnings, $2, which would give you 10. Now that means that right now, ABC is selling at 10x their earnings. So let's look at a real-world example. If we look at the stock for Alphabet Inc., which is the parent company of Google, and we want to find out their PE ratio, we would take Alphabet Inc.'s share price, P, which is $1,768, and we would divide it by Alphabet's earnings per share, which is $51.75, E. That gives us a PE ratio of 34.18. Now that means that right now, shareholders are willing to pay about 34 times Alphabet's earnings per share for a single share. Now, one thing you might notice on this page is that next to PE ratio and EPS is TTM. And what TTM is short for is trailing 12 months. And this is important because there actually are two common ways of measuring the PE ratio. One, the PE ratio of the trailing 12 months actually looks at the stock's price divided by the historical past 12 months of earnings for that stock. Now, there's another method that you might see in some places, which is PE ratio, and it might say FWD next to it, which is short for forward PE ratio. And instead of looking at the past 12 months, taking the price divided by past 12 months of earnings, the forward PE ratio looks at the current price divided by the future estimated earnings per share. So TTM looks at historical earnings, FWD looks at estimated future earnings. So which one's better? Which one do you use? Well, there's actually pros and cons of both. A lot of investors see TTM as the gold standard because it's looking at historical earnings that actually already happened. They're real numbers, they're not going to change. And a lot of investors like to actually base their own future estimates on how the stock will perform on these real numbers. They don't want to take someone else's estimates. They want to look at the real historical earnings per share. Now, the downside of looking at historical is, as we always say in investing, past performance is no guarantee of future results. So just because maybe there were high earnings in the past on a stock doesn't mean that's going to continue into the future. So that's one of the downsides of the trailing 12 months version. Now, instead, if you look at forward PE, that's looking at an estimate of the future earnings. So while on one hand, this might be more predictive in some ways of how analysts expect the stock to perform in terms of earnings in the future. And it might, in some cases, give you a better estimate of what the PE ratio could look like down the line. The downside is these are estimates and they may be wrong. So what a lot of investors tend to do is you take it with a grain of salt. You look at the predicted, estimated future price earnings, as well as the trailing 12 months, and use both of them when you're factoring in your investment decisions. So looking at Alphabet, we see that their price earnings ratio, looking at the trailing 12 months, is 34, about 34. Is that good? Is 34x, 34 times the earnings, a good value for the stock? Well, the best way to understand that is to look at an example. So let's say you're really passionate about bikes, and there's this company called Best Bikes, where the founder is right now willing to sell this company to you for a price of $100. Now, this past year, Best Bikes had a revenue of $80 and expenses of $70, which means they had a profit, which is revenue minus expenses, of $10. Now, you're interested in buying this company and you're thinking about it, but then you hear that there's another bike company in the area that's also for sale, Bikes Plus. Now, Bikes Plus's owner is willing to sell you the business for $1,000. They had a revenue of $900 last year and expenses of $400, so they had a profit of $500. So between these two companies, how do you know which one to buy? Well, holding everything else about these companies is constant, and that's an important thing that we're going to have to discuss later. But holding everything constant, you can use the PE ratio to determine which one is a better deal for you. So first, looking at Best Bikes, their PE ratio is the price, $100, divided by their earnings, 10, which equals 10. So right now their PE ratio is 10, meaning they're selling at 10x their past year's earnings. Now if we look at Bikes Plus, their PE ratio is 1,000 divided by 500, which equals 2, meaning they're only selling at 2x their past year's earnings. So looking just at this, Bikes Plus is definitely the better deal. They're selling at only 2 times their past year's earnings, where Best Bikes listed the price at 10 times their earnings. So looking at this, Bikes Plus is the better option, or at least it seems to be. Rather than having to look at the prices and comparing the revenue and expenses, you can just look at the PE ratio, and you would see that the PE ratio of Bikes Plus is 2, meaning you're only paying 2 times their historical earnings for the company. Rather than when you're buying Best Bikes, you'd be paying 10 times. So that would seem to imply that you're getting a better value with Bikes Plus. Maybe this is because the owner of Bikes Plus's price is undervaluing the company, or maybe Best Bikes is overvaluing their company. And if you're holding everything else constant, this is a great way to see what is the better deal. Now, unfortunately, holding all things constant is the key word, and this is where most new investors make their first mistake when choosing stocks. They might think that, just because this company has a lower PE ratio, that must mean that it's an undervalued company, and that's the one I should choose when investing. I should only look at lower PE ratios. And that's the problem. The problem is this is a fake example. In the real world, there's more different things about these companies. They're not the exact same with just different revenues and expenses and profits. So, for example, maybe in the real world, the reason the PE ratio is lower on Bikes Plus, the price is lower in comparison to their earnings, is because shareholders are also foreseeing some other issues with the company. Maybe they see that there's management problems that could in the future jeopardize the company. Whereas with Best Bikes, maybe the price is higher and the ratio is higher because shareholders expect a lot more value to come in the future from this company. And so that's why if you just look at these historical price earnings ratios and you just see one higher than the other, that doesn't mean that the higher one is worse or it's overvalued. There's a lot of other things that could impact that price. And that's the thing that you need to take into account when looking at this and comparing these companies. Just because one is lower doesn't mean it's better or undervalued. This is why, for example, General Motors stock only has a PE ratio of about 20.8, whereas if you look at Tesla, their PE ratio is 1,100. It's not just because one is overvalued or undervalued, that might be the case, but the reason Tesla's is higher is because investors are driving the price up because they expect that future earnings per share with Tesla are going to be higher than future earnings per share on GM. Now, the fact that it is over 1,000 leads you to see that it's potentially overvalued. But if you're just comparing the two, just because GM's is lower than Tesla's doesn't mean GM's a better buy. Now, in the real world, a good rule of thumb is when you are comparing PE ratios, it's important to compare similar companies. You're never going to be able to get identical companies, but you should at least compare similar ones. The more similar, the more the PE ratio will tell you. Whereas if the more they differ, there's a lot of other things that could be going into the price. So I hope this was a good intro to the PE ratio for people who are really trying to maximize their investing strategies. Now, in future videos, I plan on diving deeper into the PE ratio, showing you ways you can look at how different companies' historical trends of their PE ratios can help you identify which ones might be the better stock picks in the future, as well as giving you information on what other things you should be factoring in beyond just the PE ratio. And if you think I did a good job, please give this video a thumbs up and subscribe to this channel so that you can be alerted to new videos as soon as I post them in the future. Thanks again for visiting Millenica.